You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Monday. Oh my God. We're just at mid-January. I'm already done with winter. I wish I could just fly to Costa Rica and work there, seriously. Too much snow, too much minus 10, 15, 20 degrees. I know you can relate, my friends, but yeah, it's just brutal this year. I don't know what's going on, but morning runs at minus 25. I don't really like those. But anyways, that's what it is, right? Today, I want to talk about just going back a little bit on 2024 for a minute. Investment returns were through the roof, almost 30% up for the American market, the S&P 500, more than 20% up for the TSX, the Canadian market. I mean, how's your portfolio? Probably great, right? Mine was up 26%, I think. So slightly below the average benchmark that I use. So half US and half Canadian market. Of course, now I have to translate I have to consider currency translation for the US side, because last year the US dollar was up there's no tomorrow. So of course that was great for my portfolio, but then I have to consider that a part of the gains were actually coming from this. So when I look at the actual good benchmark, I'm a little bit behind, not too much, but it's okay, because dividend growth investing is not necessarily about beating the market every single year, but having a very high level of conviction to invest for several years. And when I look at my portfolio since I reported publicly in 2017, I'm still ahead of the market. So again, that's great, but it's not the reason for what I do it. I've mentioned that a few times, but it's mostly because I want to be in control and I want to know what's going on in my portfolio. And even if it means that I would be slightly behind the market, I would continue to do it. Fortunately for me, I'm actually doing both objectives, so I am in control. I know what's going on, and on top of that, the portfolio is doing better than my benchmark. So everything is great. So what to make of 2024 now? Is it time to flex, to celebrate? Yeah, well, you can celebrate for 2 minutes and then go back to work, right? Because you're gonna have a hangover at one point. And what do I mean by that? Well, if you party too much, of course the next morning is gonna be rough, right? And I'm not telling you that the bear market is coming or there's a market correction right around the corners. Who knows? My crystal ball is as foggy as yours, or clear, depending on which side you look at the balls, right? But seriously, I don't know what's going to happen in 2025, but I don't really mind. I don't mind, because it's more important to stay the course and have a clear strategy, right? The thing here is, if you look at the past 5 and 10 years, of course, insight is always 2020 when you look back. And then you're going to say, well, I should have invested everything in S&P 500. Now I'm moving everything towards there, and then I'm going to make a killing. If you're trying to do this, you're probably going to make a big mistake, because whatever happened yesterday doesn't mean that it's going to happen tomorrow, right? So you heard that so many times. Past performance does not give any indication for future performance. Well, there you go. One more time, I have to highlight this warning. So yes, your portfolio was up double digit in 2024. That's amazing, but that doesn't really matter. When I look at my pension plan portfolio that has been reported on the Dividend Guy blog since 2017, my annualized growth rate return is at over 15%. So I'm like, wow, that's crazy. But should I use 15% annualized growth rate for the next 20, 30, 40 years for my retirement plan? Definitely not, right? That would be crazy. That would be crazy because it's an exceptional moment. That's great. Good. You're ahead of your plan because the market is helping you. But at one point, it's probably going to be on the other way around. And instead of like thinking, oh, there's no more money to be made on the stock market going forward, and we should expect like a 2% return on the S&P 500 for the next 10 years. You know what? Funny story. I read a lot of articles like this in 2017, where they were literally saying, well, don't expect much from the market, because right now the market is greatly overvalued. The PE ratio is through the roof. You're paying way too much for earnings, and now you're not going to generate any returns. Well, what happened since 2017? The market is still on fire. So just to show that you never know, and past return over the past few years doesn't really matter. But what matters then, right? Like, what's the point of investing then if you cannot even celebrate? Well, like I said, you can take a minute to celebrate and take just a moment to say, wow, that was like, I achieved like great milestones. Maybe you crossed the line of like $100,000, $500,000, $1 million this year. Congratulations, that's great. But then forget about it. Like, go back to your strategy, go back to your investment plan, and just review your holdings and review your plan. Maybe your portfolio is in like super great shape right now, but that's what is important. If you're worried about the next crash that is going to come, tomorrow, next week, next month, next quarter, and next decade, whatever, you need to review your holdings. You need to make sure that they're aligned with your strategy. If you're like going for ETFs, well, that's simple. There's nothing to do. Like, just have a well-diversified portfolio. And by well-diversified, I don't mean to have like 12 ETFs. I mean to be diversified in terms of asset allocation, geographic allocation, and stocks. So you could just have bought XEQT, for example, that covers like roughly 9,000 different companies. I would argue that that's enough, right? You probably don't need more than that in terms of diversification. But I mean, that's just like a thought here. If you are like me and you're picking stocks, well, then the key is to look at each of those right now. Don't look at their stock performance last year. That's not the point. Look at your investment thesis. So the reason why you have those stocks in your portfolio, and make sure that they're backed by numbers. So here's an example. Imagine that one of your company shows great growth potential. Like, this company has several growth vectors. It's going to be amazing. They have invested massively into innovation, and they're on a roll to generate growth. So that's your investment thesis, right? You invest in that company because it's supposed to be rolling. And you look at the financial metrics and you realize that over the past 3 years, the annualized growth rate for revenue is like 2%. I mean, someone is laughing at you at this point. Like, the CEO pretty much sold you something, but it's not happening in terms of numbers. And this is when you should reconsider the holdings in your portfolio, when the reason why you have invested in the first place are not backed by numbers, are not backed by facts. It's one thing to believe that a business is going to expand its horizon and show splendid revenue growth and earnings growth going forward. But if it's not happening after 1 year, after 2 years, after 3 years, there's a limit to be patient, especially when the market is trading at such a high valuation. And when I'm talking about valuation here, I'm looking at the average PE ratio for most stocks. A lot of those are pretty much above their 5-year and 10 years average, which means that you pay today more than you would have paid 5 years ago for the same business in terms of multiple of earnings. It's one way to see it. You could look at the yield. You can also use complex models to determine the valuation. I like to keep things simple in that term because your complex valuation model is just as good as your assumptions, and your assumptions are just as good as a crystal ball. So again, it's up to you, but it's better to look at things that are simple, such as, is the company's doing what they told me they were doing? So is the numbers are there? Yes, I'm going to keep it. If they're not there, well, maybe it's time to revisit some of my position and sell before there is a market crash. So, all right, Moose, that's enough for today. So long story short, 2024 was great. Congrats to you. But now it's time to make sure that 2025 will be great as well. And the only way you can do that is making sure that your portfolio is aligned with your strategy and the numbers are backing your story. So take good care. We're going to talk again tomorrow, and we're going to talk about the fact that growth is not certain, which is kind of interesting, right? So stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.